Hello everyone, welcome to Financial Risk Management. In this video, we're going to take an initial look at the financial risk. So what do we mean by a financial risk? So suppose that we have stock, right? So this is the stock price at day T. Now, the next day's stock price may change, and depending on how it changes, we may see the increase in the price. So ST plus one, which is the next day's price, it may increase, right? And then there's another possibility, it may decrease. So this is going up, and this is going down, right? So this is next day's price. So because it is the very reason that we're not sure about the outcome for the next day, that we see that the stock price is uncertain. So the outcome is uncertain. So it is because the outcome is uncertain and we're not sure about what's going to happen with 100% confidence. So that's a risk. Okay, so the risk could be going up or going down. Of course, we like the risk of going up because it leads to a profit, right? Assuming that we are holding the stock. However, if it goes down, then we are going to suffer a loss, right? So usually, how do we capture such randomness, such uncertainty? So because it is uncertain, it also random, right? So that's a randomness inside this outcome. So usually we use random variable. Okay, so this is where the random variable comes in to see that this event, it could be going up or could be going down, right? So itself is random. And now there's also a probability that we usually assign to this randomness, to this random variable. So we see that, for example, this random variable is S, right? And then S can only take on two values. So it could be taking on the value of going up, right? Or going down. And now we say that these are the two possible outcomes of this random variable. And also we also assign it with a probability. Okay? So what is the probability of both outcomes happening? So it could be going up 50% and going down 50% as well. Right? So this is essentially a distribution. So for each outcome, we have the corresponding probability or the likelihood of happening. And this is essentially a random event for us. But however, in this case, this is a purely equal probability. In other cases, we could say that, oh, this is 80% and this is 20%. Right? So maybe you have some strategy and then you calculate the probabilities of experiencing a profit or a loss, and then this is the resulting probability. So clearly, this is a much better probability distribution than the first one. Okay, so essentially, what is risk? So risk itself, it represents randomness, represents uncertainty. So there are two flavors. It could be going up. So this represents the opportunity for us, right? And if it goes down, it represents the real risk, the potential loss for us. Okay, so this is how we essentially going to capture the risk itself and then in a quantified way. All right. So let's look at the curve of S&P 500 index. So this is the daily index, and now so which this essentially represents the a collection of points. So if I were to take a point, right? So this point represents on that particular day, the value of that index is this one. Okay, and then we're going to do the same for all the different days, and then going to connect the dots to form this curve. So this is how you see the curve. All right. So what's the takeaway from this curve? So in this curve, we see a sharp drop in this period And this period is essentially the starting points of COVID-19, right? So it's about the early 2020, and then around February to March, we see a sharp drop in this period for this index. All right, so if you're going to invest in S&P 500 index, now you're going to experience a huge loss in the portfolio itself. So this is also the risk for us, right? So clearly in this example, it seems to be more likely to going down, right? And then even if you look at a single day, so if this the day we are looking at, all right, the next day is going to be uncertain for us. We're not sure the next day's price is going to go up or go down, right? So this is the uncertainty we face every day if we're going to hold this asset. So there are multiple things we can take away from this graph. So first, seems to be more likely to going down, right? So we can also um, use some other graph to capture, what is the probability of going down or going up by looking at how many days, maybe 100 days, right? And then there are 6 days to go down and 40 days to go up, right? For every next day. Okay, so now we see that, there's a maybe 60% probability of going down and then 40% going up. So this is how we can calculate the probability of going up or down just using the historical data, okay, from this example. And also there's another flavor, which is by how much, right? So by how much. So even if the stock may go down by 60% probability, but how much would the drop be? Okay, so how much is the drop in the asset price? So this is something that's we can capture as well. So there's something called drawdown. So drawdown essentially means that how much is the decrease in asset value for every consecutive days, right? And then if we were to look at, what is the maximum? Okay, so what is the maximum drawdown we could have experienced if we were to go in, take the asset, and then hold it? Okay, so clearly in this example, seems to be the highest point, and this is the lowest point. Okay, so the difference between these 2 points is the maximum drawdown. Okay, so if we were so unlucky, right? So we went in the market holding the assets at this day and then sold it at this day, then we could have experienced the maximum, the worst drawdown, the worst loss in the profit. Okay. Now, so this is a bit of analysis for the S&P 500 index. Now, there are multiple types of risks, and we're going to discuss a few of them through this course. So the first and foremost risk will be market risk, right? So if you participate in the trading activities in the financial market, there will be market risk, and this is the very risk that represents the fluctuations. Okay, so because the price itself is random, and then randomness gives rise to fluctuations, and the fluctuations could be potential risk, right? So, and then this could result in the loss in your portfolio. All right, so of course, it also represents potential gain as well. So depending on whether you are risk averse or risk seeking. There's credit risk as well. So credit risk itself is very different from market risk. So credit risk says that if you were to uh, lend your money to someone else, right, but the other party did not fulfill the obligation to pay back either the principal or the interest. Okay? So it describes someone failing to repay the debts. That represents credit risk. Okay, so of course for the banks and bonds investors, they want to look at lending their money to those who are creditworthy. Okay, so who are trustable, and there are different models employed just to capture, just to quantify how trustworthy those borrowers would be, and just would, for example, set different sort of level of trustworthiness, and then capture that risk. Okay, so that's credit risk. And there's a liquidity risk as well. So liquidity risk is the risk that if you were to go in for some assets and you want to exit the position, it is not so easy to exit types of risks. So there's a operational risk as well. So which is essentially concerning the weak links in the internal processes in companies and institutions or the systems. And also there's a legal risk as well, so which is that the companies may spend some capital on the lawsuits or just to deal with regulatory changes. Um, for those, for example, the Monetary Authority of Singapore has a set of regulations for the financial institutions. There's a systematic risk as well. So this risk represents the collapse in the entire financial system, right? So in this case, diversification may not necessarily help, right? So it triggers a chain effect in the entire financial system, and therefore it's the risk for the entire system. There's a model risk as well. So model risk represents the risk that is triggered due to misuse or the insufficient capacity of models. Okay, so the models are flawed or they are incorrect in terms of assumptions they use. Okay, so some examples of challenges could be because the financial markets are volatile and dynamic. Okay, so meaning it's very difficult to predict the price itself, right? So because it is susceptible to so many moving pieces, so that no model can predict the price properly. So itself is volatile and dynamic. The second thing is that the models can be outdated as well. So because the financial markets change very quickly, and then if we do not update the model in time, it could be outdated as well. Okay, so we also need to manage this type of risk as well. All right, so that's so much it for this sharing, and thanks for watching, and I'll see you in the next video.